deviations, how to trade them. They're all around us in the world of probabilities and derivatives trading, Katie. And today I want to do a little background work on standard deviations, what the heck they are, how you can calculate them at home if you want, how they make their way into all your trading, and how they can inform future trades. You're a big fan of the old bell curve, right?
Yeah, well, I mean, I thought that I left the bell curve behind in high school after I stopped having to do a math requirement. But that said, obviously, it has come back to, I don't even want to say haunt, because as we'll come to explain today, they're powerful tools. And I think it's super timely because everything we just saw yesterday with CAR and DWAC, I mean, that also can be, it can be explained with a bell curve, right? And a standard deviation. So really timely conversation. And more importantly, like you said, tradable information that helps us better understand movement of a given product and helps us better be ready for our own changes in risk tolerance or risk appetite as well.
Absolutely right. It's one of those things that you picked up probably in high school or in college in like a stats class or something. And it's amid like trigonometry and these other things. And it's like, I'm never going to use this stuff. Why are you even telling me this stuff? And trig, I am kind of like, that never really came up. But anyways, standard deviations are one of these things that like, I don't want to go to bat and say that it's as essential as like addition and multiplication, but it, like, especially if you're trading options and futures, it's really in everything. Like you don't really notice it. It is the basis of volatility. Like if you went through an advanced math class in applied mathematics, which I stupidly did in college, and you broke down like Black-Scholes and these volatility models, it's all stripped down. It's based in standard deviations of data. And so let's get into it and teach people what the heck it is we are talking about. And none of this, like, I don't want to get too heady with it, like theoretical or anything. I just want to kind of give people what it is from like in layman's terms, because that's what we care about, is just like, how does this make sense for me making money in the future? And then run with it to a product, and then run with it to our trade page and see how it is applied in the futures world every day for trading opportunities. I mean, standard deviations run almost all statistical analysis in trading, almost everything from Black-Scholes and options to, what traders in professional settings are using in futures. Like I've been in the board of trade. I've been in these rooms where pros, what are they looking at when they're trading outrights, when they're trading spreads, all these different things. And standard deviations run all of that stuff. And it's essentially just taking all of the data that's under this curve, Katie, and spitting out like one number that's essentially kind of like a boundary, right?
Yeah, it's helping us quantify a particular outcome.
Exactly right. I just said a million words as always, and Katie refines it to like 6 actually smart, essential words. And here's just 2 numbers for you: 6 and 8. 68% of data resides in a standard deviation. And you can I can get real buzzwordy with it and say confidence interval. There's a confidence interval about 68% that if you spit out a number, the plus or minus sigma there, the plus or minus, if it's a stock that's $10 and the standard deviation is plus or minus $1, that's just telling you that the historical movement of that product on a daily basis lives within up or down $1. And it's a good 68% is the number that is attached to one standard deviation. It's what we live by when you think about 16 delta strangles and everything else. It's not perfect. Of course, everybody wants 100%, but at 100%, there's no premium, there's no opportunity, right?
Exactly. I mean, even, 2 years ago, we would have said crude oil would never go to zero. And maybe that could be some way that you can say, oh, there's 100% certainty crude is never going to zero. Well, guess what? It did. Like you said, we live in an imperfect world. So we have to be willing to, and that's the whole point of trading in probabilities, is that, you have to have a certain amount of risk and imperfect information in order to garner some type of reward.
And that's a great example. Let's hang on that for a second before we get to equities here and go all the way to the trading platform with bringing this theoretical math measure to applied trading. Crude oil is something that on a yearly basis, I would wrap the standard deviation. If the market, like it was going into the start of last year prior to the pandemic, let's say crude oil's at like $50 or $60, which is a pretty good like average price for crude, all things considered. You would say the standard deviation by the end of the year would be like, oh, plus or minus like maybe $20. So that means like up or down from 50 down to 30, up to 70. So 30 to 70 is your range. And if you're into strangles and stuff like that, that's where you sell your calls and your puts. And that's where the standard deviation works in there. Now, here's the deal. Like Katie said, the market can, if you get 100% in your data, in your strategy, you're never trading, because 100% would be literally negative values in crude oil all the way up to like $150, places it's never been. And it's like, well, now I have 100% confidence interval because it's never been here. But guess what? You never trade. Even if you bought crude oil at that $30 level, you stepped in front of that train and it went through you. The market came back above 30. Like that's, you trade and you look at these numbers that are imperfect because outside of the standard deviation is where the opportunity is. And if you get 100%, you just never trade, Katie.
Right. Yeah. I mean, there's a couple of things. There would be, if you were doing options with your strangle, there would be no premium there. So like you said, you couldn't trade. And even further than that, if it is perfect information that every single person has, there's going to be no participants. There's going to be no one to take the other side of your trade.
Like you'll wake up every day, put in your bid to buy crude oil at negative $50, put in your offer to sell crude oil at $150, and just look at it sit every single day and never get hit there. So it is this matter of, I understand when people are like, they learn about this and they're like 68% doesn't seem high enough. Why don't you go higher? And you can. 2 standard deviations are 95%, but the more perfect you get with the amount of data that lives in 1 standard deviations or 2 standard deviations or 3, which is 99.3% of the data there, the less opportunities you get. So 68 is a really good number of both like, okay, if it gets outside of this, it's an outlier, it's a rare move, but also it's something that, especially when you're looking at equities, commodities, interest rates, foreign exchange, cryptocurrency, which now is obviously huge and more products coming out of the woodwork every single week, you're going to have a market that has an opportunity every single day when you use this solid but imperfect number. And now let's look at this with the daily. These are all the daily moves in the small stocks 75 futures, the SM 75 futures. And the 1 standard deviation is right around plus or minus 1.25%. And so you're going to have, Katie, outlier moves where the market is up 2 or 3% or down 2 or 3%, or even amid a market crash, down 5% moves or 6% moves. But look at all the data points inside of there. That's where you get 68% of the last year's worth of daily moves in the stock market is in that range. And when we're outside of that range, that's when people like you and me find opportunity.
Right. And I think that brings up a really good point is I think for new people, the idea of having this information, you also need to remember you need to have enough occurrences to base it off of. So for somebody that might be brand new, like yesterday was their first day trading car, like you're not really getting all of the information. Like you need the full data set or some historic information to help you better identify those opportunities, right? Because if you saw like car skyrocket yesterday and you think, oh, like maybe this is a common thing that happens. Sure. It doesn't. And that's why having a wide enough data set and a large enough number of occurrences to show like the consistency here, like that's another big piece of how you eventually, push, confirm, and send on your trades and feel confident in your probabilities.
And I'm glad you bring up this outlier, kind of rare occurrence of this week, because this stuff is attributable to every market.
Right.
Like every single market that has, we usually spit out standard deviations for daily movement in the last 3 months. So if you've got a market that's got 3 months of price data and information, we're able to look at this stuff and say, okay, the market moves in the case of SM75 about a percentage point a day. So if it's up or down 2 or 3%, that's a rare move. And that's when I'm ready to jump. You could do the same thing with Tesla. It's just a matter of applying the same numbers, and you're going to get spit out a number that's 5%, 6%, or cryptocurrencies. We do this for the small crypto product here at the small exchange. Same math, same understanding. It's just 2 or 3 times that of an equity index future like the small stocks or the S&P 500. So now that we've gone from theory to some actual applied numbers in the market, what do we do with them? I mean, there's two different things you can do as a day trader or a swing trader, just an active trader in general. In options, it's pretty simple. You're either looking at these standard deviations and you're saying, okay, I want to be a seller of the strangle at these standard deviations or the iron condor, or I want to be a buyer. When stuff starts to move, I like to ride the trend. Or when stuff starts to move and volatility gets higher and those standard deviations, guess what? Widen out with that volatility, because standard deviations help function that volatility number. It's all part of the same cohesive idea. That's when you're looking to jump, to either buy or sell that strangle. It's pretty similar in futures here, Katie, and maybe you can speak to these numbers that we're looking at. It's the 1, 2, and 3 standard deviations for SM75, knowing that the 1 standard deviation is about $1. When you see SM75 moving outside of $1, I mean, what are you looking to do in the futures?
For sure. I mean, this is great. I use this every time I'm looking to add like small exchange products to my portfolio. And this does a couple of different things for me. First off, of course, I can use this information, this standard deviation that you guys churned out and look and compare it to today. Okay, SM75 right now, it's up about 31 cents. So that doesn't signal an opportunity. Maybe I look for something like SMO, where we're having a little bit of a larger percentage move on the day and capitalize on an opportunity there. So I definitely not only use these for entry, but then say that maybe today SMO is down closer to a $1.50 or something along those lines, and maybe I want to buy in. I also would like to use this information to get a sense of ranges over the next few days as like a scalp or a swing trade too. So there's a couple of different ways that I like to use the standard deviation bell curve, and two of those being the things that I just listed.
No, I'm glad that, because that does take the trade from A to Z, really. And we'll look at a couple potentials, SMO and others included in the platform here in a second. But it is the idea of like, okay, I've got the standard deviation number. For SM75, it's $1. For SMO, it's like $1.50. For some of these other products, it's 30 cents, 40 cents, depending on just how volatile the market is. Everybody knows about volatility. Coca-Cola is less volatile than Apple, which is less volatile than Tesla. And the standard deviations go from small to larger to largest, depending on how volatile that market is. But I love that it's not only signaling the opportunity. A market that has a standard deviation of $1 that's up or down 30 cents, no opportunity for me there. But if it's outside of that standard deviation, it's not enough to be like, oh, it's down $2 and its normal day is inside of $1, so I'm just going to buy it. Now what? Well, knowing that the standard deviation is $1, Katie, lets me know that if I'm day trading or, trading for just the next 24, 48 hours, the next week or so, I can't expect to get $5 out of a market that moves on a daily basis $1. Seeing that the market's down more than the standard deviation, buying it, and then hoping for 3 or 4 standard deviations of movement to the upside, less than a percentage chance of that happening. So realistic on the entry and exit. And for those out there who are interested in these numbers, we do give them out to our community members every single week. They also get 50% off exchange fees on all of our products for life. Community.thesmallexchange.com. I'm sorry, Katie, but I had to plug it there. Now let's get into the platform and look at some of this stuff.
For sure. And I think while you're doing that, the other point that's worth mentioning is people sometimes will take that information as really black and white, right? Oh, at one standard deviation, it's up or down $1. At two standard deviations, it's up or down $2. Therefore, if it's down, a buck 15, maybe I should wait for my entry until it's down $2 or up $2. Where we know, and we've talked about this a lot, you can't get so hung up on like those very specific $98, $1.97 to get into your position. Like you're never gonna, paint the top and the bottom.
Yeah.
Like you have to be willing to take risk on both sides. And because also that information can change it at any given time as well.
100%. All this stuff is dynamic and it's meant to just kind of signal in your brain, like, okay, that's on interest. Like we just did the whole segment on stocks. And really quickly now I can go to the platform knowing that SM75 standard deviation is $1. It's up 30 cents. There's nothing for me there. And you do the same thing with the, older products here in S&Ps. You do this kind of without subconsciously, not even noticing. Like if S&Ps were up or down 30, 40, $50, then you'd be like, oh, something's going on in there. Right. It's down 6. It's not outside of standard deviation. There's nothing to get done in there. And yeah, it's a matter of, SMO, the standard deviation via this is small crude oil, via our math and statistics is about $1.30, $1.35. It's down $1.90, like ding, ding, ding. There's something there. Now looking at this market, Katie, knowing that it was 30, 40 cents lower at one point this afternoon, hopefully a lot of you out there, community members who are looking at these markets, were able to get down at those lows. The market is still down that standard deviation and there still is potential. And just as an example, I would look at, okay, market's down $2. The standard deviation is $1.25. I can look at, for a day trade, buying this market down here at 81.28 here, knowing that the standard deviation, like I say, is $1.25, just got filled there. And now the idea for with Katie went through so eloquently on using that standard deviation to manage is like, okay, now I'll look to take maybe half a standard deviation out of this. Like if it's $1.25, I would look to take maybe 60, 70 cents. And so I put my offer in to cover for a potential profit up at about, I bought like the 81, let's just round it off, 81.30s. I'm looking to maybe sell back the 81.90s. It's that simple, right?
Exactly. And I'm also in smalls at 81.36 as of this morning. So you got in a couple pennies better than I did. But now we're both in the long oil game.
Very nice. And this stuff is, using statistics like this are great for taking emotions out of trading and just trading off of the actual hard data there. Like I don't have to wade through the news of like, is crude oil going higher? Well, look at the supply chains. And it's like, oh my gosh, I don't want to form an opinion based off of emotions and the secondhand news that I'm getting. It really is as simple as like the stats are out there. I know that there's, a 68% chance that we settle back in that range. And I can apply it on a day like today. I can apply it to SMO. I can apply it to SPRE is down more than a standard deviation. S2Y is up more than a standard deviation. You've got the SCCX, which is new and liquidity is getting better and better, but still a little wide in there. But this is a market, Katie, that yesterday was up a standard deviation. Today is down a standard deviation. And so you're seeing these things across different asset classes. We'll see how our crude oil trade goes. I mean, this market was up a standard deviation a couple of days ago. We were selling. It came down to the middle of the range, and that's using standard deviations to trade. Thanks so much for joining me here, Katie.
Beautiful. Yeah, again, it's such like fundamental stuff, but as you said, it helps you remove emotion. It helps you see the bigger picture. It helps you realize that this is just one trade. And just like with the standard deviation bell curve, not every trade you make is going to be a home run either. So that's why there's also importance in upping those number of occurrences, because that's what's going to start to have your P&L align with that standard deviation too.
Exactly right. I mean, today we just went through on the small exchange products alone, there's 3 or 4 of those occurrences. Hopefully you win 3 out of those 4 and your percentages start to look like 68%. Like they're looking for. And as long as you're, as long as that crude oil trade, if I was going to take 60 cents out of it, $60 to the upside, I'm taking the loss down there and I'm not letting things get out of hand or get emotional. there, Katie, my returns will, by the law of large numbers, start to look like that bell curve there. So always great to have you on, but we must move out of here because our friend Peter Momat is waiting in the wings. Splash into Futures is coming up next. A bunch of trades to get done here. Stock's still not moving, but everything else is moving. And so we'll get some trades going. Thanks, everybody, for watching.
Peace.